Good morning. It's Monday morning and we're ready and raring to go to start the week. Start the week with a bang, really. So one of the questions that came up in the group last week was how to use the chart of accounts. What is the chart of accounts and how can we use it to be a little more creative? So we're just going to jump over into Xero and show you some of the things that we do in our chart of accounts. Now remember, although we are using Xero, you can use any system and apply the same principles. So I'm going to ask Harry to quickly flip over into the accounting module and pick up the chart of accounts. Now the chart of accounts is it's all of the transactions, the account codes, usually in a relatively sensible format. So you'll have a series of account codes for revenue accounts. So if you scroll up to the top and go onto Xero, they sort of set them all out.
Zoom in a bit as well.
Yeah. So if you go into the revenue accounts at the top, just pick the revenue menu. So most chart of accounts for most software packages will have revenue expenses, and you can see here they're a combination of some have got 20% VAT on income, some are no VAT for interest, for example. So we like to see the accounts broken out in as much detail as possible. We are firm believers of more is more when it comes to account codes. And you can group them when you're presenting them within reports, but when you're actually measuring and tracking transactions, we like to see them in more detail rather than less. So in your sales, for example, you'd have all the different types of sales, the different types of revenue. So Harry's going to add one here for a new income stream. So say we had sales type 1. So say this is courses. Say we're doing courses. This could be something that was different to the way we might be measuring our other sales income. So you would typically say, you know, we've got sales type 1, we've got other revenue, we've got different options down here. You'd make these specific to the type of income that you've got, but here you can see that we've split them down into sales type 1, sales type 2. Now, if we go back a tab, you can see that there are expenses items. Now, expense account codes are usually split into two different types of account codes. So there are direct costs, which are your cost of sales. These are the things that directly relate to your sales. So if your sales increases, your cost of sales would increase. They're the direct wages, the direct expenses, subcontractors that go into delivering those services, but they wouldn't be the overhead cost. So the overhead cost is the kind of cost that happens whether you have sales or not. They're not directly related. So it includes things like bank fees, cleaning, consultancy, entertainment expenses, postage, insurance, keeping the lights on your business premises. Then we have equity accounts, which are the funding elements of your balance sheet. So this is your retained earnings, your funds introduced. Now, funds introduced in this concept is usually for a sole trader, not for a limited company. If this were a limited company, this would be a director's loan account and it would appear as a current asset or a current liability, not down the bottom of the balance sheet in this equity section. So liabilities, as what it says on the tin, these are the things that your business owes to other people, like wages that are owed to your staff, taxes that are owed to HMRC, director's loan account if you've put money into the business and the business then owes you. And then we have assets. So let's pop over to the assets, and these include things like your fixed assets, your stock, cars if you've got any motor vehicles. It might include your director's loan account if you owe the business money and it's an asset to the business. So that's a very quick run through of the accounts, and you can see in Xero that each account code, if you just click on any one of these account codes, each of these account codes has click on sales type 1. Sorry, not very clear on that.
It's all right.
So it's sales
Something
type
called kicking
1.
in the bank was going to work.
What is really handy here is the ability to write a description, and that you can also show them in the dashboard watch list. You can set this particular account code up if you use expenses claims, or you can make the account code work like a bank account, which you wouldn't do in revenue, but you might do in your balance sheet if you wanted to enable payments to this account. So it might be a director's loan account that you want to be able to act a bit like a bank account. So say, for example, you paid a supplier, or you bought things, you perhaps received cash from a customer and they paid you and not the company. You could then put that cash in or out to your director's loan account. Anyway, just taking a step backwards a little bit, one of the things that we wanted to talk about today is how to be a little more clever with your chart of accounts. So Harry set up a sales type 1 and a sales type 2 account. But one of the things that we can do with chart of accounts, our first tip, is to use a cost of sales account code to match your sales account code, and that way you can track how much the cost of goods sold is in relation to that particular sale. So say you have training courses or membership courses or a particular product line or a service, if you can track the income of that service and the cost of delivering that service, then you'll get a better understanding of how much that service, product, or whatever it is contributes to your overhead or contributes to your business. So you can use these types of account code to track both the sale and the cost of sale, and therefore the gross profit on each of your products. So we use those quite a lot in our business to help our customers understand which products and services are making profits and which ones perhaps aren't.
Really simple little change as well.
It is a simple little change. Now, it's easy to set up in the chart of accounts. It's not necessarily that easy to set up in the business, because you have to understand what costs and what transactions actually relate to all of these different products and services. So this is one of those things that you need to think through with your accountant if you want to use this type of analysis in your management accounts. If you're the bookkeeper doing that kind of work, have the conversation with the client to see what they want to measure and what's important for them to understand in their business. And as the bookkeeper, the more information you can give them on what makes a profit and what doesn't, then the better quality of service you're delivering to your customer. So top tip number 2, we are big advocates of using the chart of accounts to measure your corporation tax. So I'm just going to scroll down to corporation tax, and in here we've got a provision for corporation tax here in 830, but I'm going to ask Harry to make that one for the current year. So say we had a December year end, that would be for corporation tax for say December 19, payable in September 20. And then we'll put that on the watch list. And then we'll save that. And then we're going to create another one. So say because this is corporation tax for the end of December 19, we will have already calculated that tax liability for the end of last tax year, so that the customer can see what tax is payable. Now, then we're going to create a second account, and this is going to be for the corporation tax for December 2020, which is due in September 21. Now, although we're only current year, what we should be doing as we progress through the year is accruing that corporation tax liability in our customers' accounts so they can see how much is due. Now, if you just pop back to the dashboard, you can see the corporation tax liability for the year past is already in the accounts, and the year current needs to be journaled in as we do the management accounts. So this is a test system where we haven't done that, but you can see how that tax liability then pops up and is visible. It's right quite in your face, so it's visible and people are aware, the client is aware of what their tax liabilities are. And that's something, again, as the bookkeeper and the accountant, you should be talking through with your customer. Tip number 3, we quite like to use account codes for VAT. Now, in Xero and most accounting systems, there is one, maybe two account codes for VAT. But what happens if you're cash accounting for VAT? In Xero or in the VAT account, what you'll see is the VAT liability that is calculated from the invoices that you've received and the invoices that you've raised. If you're cash accounting for VAT, it doesn't show you what your actual liability is. You have to go and find that out by running a VAT return. Now, some of our clients who are a bit cash sensitive, what we do here is we create a second VAT account, say account number 821, and we will do a VAT liability account. So VAT liability might be cash basis, due 7th of March 2020. So what we do at the end of each month is we journal out the VAT that has accumulated, the VAT liability that has accumulated on a year-to-date basis, and we pop that into a separate liability account, again, which then shows on the dashboard watch list, so the client can see when they jump into Xero what their liability is. Now, the thing that if you're going to do this, you do have to make sure it's absolutely clear that this is VAT on a cash basis. Show what date it's payable, so this will be for a January quarter end if it's not due until 7th of March, and then make sure the client knows it's, month 1 of 3 or month 2 of 3, month 3 of 3, so that they know how far they are through their VAT quarter. Most of them know that if their VAT's due on the 7th of the 3rd, 2020, that actually relates to a January month end, but they don't necessarily know that you've already journaled all 3 months into it. So that's a conversation that you need to have with the client if you use this. Now, the other times when we would use this type of account is, Harry's going to set up an account code 822 now, is if you have VAT arrears. Now, if you get into a situation where you can't pay your VAT on time, say you've paid half of it or a quarter of it, and then you set up an arrangement with HMRC to pay the rest, journal that VAT liability, the unpaid VAT liability, out into a separate account code. Again, show it on your watch list, and then you can have that reducing each month or each week, depending on the arrangement that you've set up with HMRC, to show that VAT liability going down. And again, it brings that information to your attention of your customer or the director, so that they know exactly where they are with their VAT liability.
And it's really handy to have the two in combination, because if you are paying down arrears and you do have an arrangement to pay in place, you must keep up to date with the current period. Yeah. So you must know what's going to happen in the current period as well as what you're paying down historically as well.
Yeah. Now, what I'm really keen on, and if you can get your clients to work through, is to set up a separate account for your VAT and push all of the cash for your VAT over to a separate account and have it collected by direct debit. And if you have your VAT paid by direct debit, not only do you get an extra 3 or 4 days to pay the VAT than you would if you were paying it yourself on the 12th, on the 7th, you get an extra day, a few days from the 10th to the 12th. So it's for 3 working days after the 7th, however that falls. It gives you a little more time, and if the cash is ring-fenced into a separate account, separate bank account, then it's more likely that you won't touch it and you won't accidentally spend it before you get to the end of your VAT quarter. So do that in your accounts. Get your clients to set that up. Tip number 4 is office equipment. Now, if you just type in there, Harry, search for office equipment or search for office. A really common error we see when accounting in Xero is that you'll often see office equipment is actually a fixed asset account, but when you're searching for office equipment, maybe you've bought, say, some consumables. You might have bought something that's too small to depreciate or too small to set up for an asset. And what happens is that gets coded to the balance sheet as an office equipment account code instead of to the P&L. So set up an account code for office expenses, which can capture all your generic stuff, things like your kettle or your toaster, or if you've got a little kitchen, that kind of thing. And then change the description of office equipment, which is the fixed asset account, to office equipment asset. And if you do that, then you're less likely to pick up the wrong account code. Now, a similar thing happens with motor vehicles. So you often get people putting, if you do a search for motor now,
Motor's
you
very
quite
common,
often see people coding motor vehicle expenses to motor vehicles. So again, change motor vehicle expenses or keep motor vehicle expenses as expenses. And that's not in all accounts. That's something I think that we've set up. And change motor vehicles to motor vehicle asset. And again, that makes it much less likely that you're going to make a mistake and post things to the incorrect account. So it's just taking the time out to make sure that the account codes are separate.
Because that's an easy mistake. Just type in motor in your chart of accounts when you're posting a transaction, and they both come up. So it's easily done.
Yeah, and you don't see when you're posting an invoice, you don't necessarily see the account code itself. So if you know that 400s are overheads and 700s are assets, then you'll know not to code it to that account. But if you rename the account and make it more clear as to what the account code is, you're much less likely to put things in the wrong place. So talking about those, let's do a search on entertainment. So entertainment is one that really confuses people. And what you'll see, Xero's default is entertainment 100% business or entertainment 0%. And that really confuses people sometimes.
Yeah.
So I would turn that around, and that one that's 100% business is expenses incurred on entertainment by the business that for income tax purposes are fully deductible. What does that mean? It basically means that's staff entertainment. So let's change that to keep the 100% because I quite like to see that. I always do it the other way around. So I keep entertainment dash staff 100%, and then take out the business at the end, and then entertainment dash business is 0%. So sometimes I call that business, sometimes I call that client or supplier. You need to remember that it's actually client and supplier, not just business entertainment or not just supplier entertainment. It's all of them. It's anybody that you schmooze and take out, and it's 0%. So you make them as default, so you can reclaim VAT on your staff expenses, you can't reclaim VAT on your business expenses. And if you keep the two expense entertainment account codes different and rename them so it's absolutely clear what they are, you're less likely to make a mistake on the posting. Now, fifth tip for looking after your chart of accounts and making them a little more explicit is your director's loan account. Now, most account codes, so usually about 835.
I'm just going to search.
Yeah, usually about 835 in here. Now, quite often we use the director's loan account as it stands in Xero. So this is money owed to or money owed from directors. Now, some clients we find like to see how much cash they've put in or how much cash they've taken out. So in that instance, we separate the two so that you've got director's loan account and it might be cash out. So sometimes clients like to see the dividend that they've taken on a monthly basis, and they like to see any additional cash that they've taken that perhaps isn't covered by profits, or it might be a reduction of the cash that they've put in. So have a talk to your client, have a conversation with them and understand how they want to show their director's loan account, how they want to see that. We have other clients that like to see how much they've spent. So some clients, although they probably shouldn't, do sometimes use their director's loan account or their business bank account as an expenses account code. So let's have director's loan account expenses. And these might be things like, fuel receipts or a bit of shopping if they picked up the wrong card, something like that. So this isn't cash taken out necessarily, but it's the cash equivalent. So they've spent money out of the business account that they shouldn't have done. So with most clients, you can just stick that straight to 835 in the director's loan account. Some of them like to see how much they've used and how much they've basically overdrawn from their business, and how much is that should go into that expenses account. So you can break it out into all sorts of details.
And you might even have all three of these subcategories with a single director. So it might be director's loan account, director 1, cash out. So there's lots you can do with this. And of course you might see that you're adding a few codes and you're probably wondering, well, what happens if I run out of codes? Like, I can only add 839 before I start getting to 840s. There is a way around that. And one way is, if say director's loan account is 835, you can just use 835 again, which is obviously going to clash, but you can always say add 01 after it. So you could be...
Or in that instance,
A,
we
B,
quite
C,
often
D,
use the initials, don't we? We use the initials.
Exactly. So it could be me, for example. So there's all sorts you can do to just extend the codes, meaning that you don't have to constantly place codes all over the place. Yeah. So that's just a clever little way of saving coding.
Yeah. Now, the other thing that you can use the director's loan account for is what happens if Director 1 has takes an extra dividend and has, say, £5,000 out. Director 2 decides to wait. You can account for those and accrue for a dividend or accrue for that spend in the director's loan account without them having to actually take that money out of the business.
And then it's
again,
really clear.
We have that in some businesses, don't we, where some of them want the cash and some of them don't want the cash. They want to save it till year end or have it closer to Christmas or whatever. So that sort of mismatch can be accounted for in different directors' loan accounts. And again, if you want to see them on the dashboard, on the watch list, you can put them on the watch list or not, depending on whether you want to see them. So let's save that one. Right, number 6, top tips for using account codes in a clever way is for recharges. Now, quite often, businesses incur costs or expenses or travel expenses that they need to capture, and it becomes a cost of sale. So we're going to have that as recharges to expense or costs to recharge, depending on whatever you want to call it. And then have a separate account, which is an income account, which is called costs recharged. Now this way, if you have costs coming into your to recharge button or to recharge account code, and then you can measure them and check that you're recharging all of them in the sales account as they go out. So the one should offset the other. Might not necessarily be in the same time period, in which case you can use things like project codes and tracking codes to track that 100% of everything that you've incurred has been recharged in, might not be the same month, but it has been at least been recharged to your customers. So we use that an awful lot with costs to our clients who have costs that need to be recharged.
That's really, really helpful.
Yeah, so our 7th tip is really that more is more. So we like to see more account codes and more detail. If you want to manage something, then you need to measure it, and you measure it in account codes. So don't be afraid of overusing account codes and creating more account codes than you might think that you need. It's better to have more costs in more granular detail so that you can see what they are and that you can measure them and track them. For reporting purposes, you can always group them and just look at, say, single lines for, office overheads and premises costs and admin costs, that kind of thing. But if you want to be tracking things and making smarter decisions, break it out into more detail. Yeah,
far easier to do that and just edit your report formatting than to suddenly realise actually you want all of this granular data, which and just isn't there. Yeah, so better to split it out and then summarise.
Yeah. So that's it from us today. Do let us know if you've enjoyed this video and if it's helpful, and we'll speak to you again soon.
Thank you very much.
Bye for now.
Bye.
Bye.